Hello and welcome to another episode of the Opus Wealth Style Podcast. My name is Iván Watanabe here with my high school classmate Morgan Keim. Morgan, how are you today?
Hey, I'm great, Iván. How about yourself?
I'm doing really well, man. It's good to see you.
Great to see you too.
Excited to have you on the podcast today. Kind of tell us more about what you're up to. Love what you've been working on, and I sort of caught wind of some of the different projects and the things you've been up to on social media. So really excited to have you on today to come, tell us more about you and sort of the projects you're working on.
Yeah, no, absolutely. My story is a pretty non-traditional one, but I'm the managing partner of a company called Ocean Ridge Capital. Our focus is acquiring and turning around workforce housing nationally. And I actually spent a decade managing the commercialization and venture raising for food tech startups, totally different space, before I came to the gut-wrenching realization that income wasn't necessarily freedom. And so that caused me to make a big shift in terms of actually going back to what I had always used as a hedge for my startup sort of barbell strategy in wealth building, which was multifamily real estate. Steady cash flow, tax benefits, more control. So now my main focus is essentially helping entrepreneurs and high net worth investors create freedom outside of their ventures or their primary thing to create diversification and really kind of compound their wealth quietly.
Yeah, I love it. And you shared this with me the other day, but why don't you just kind of tell the listening audience more about how you got into real estate and your first deals, and I love the story, so I know they'll find it interesting.
Yeah, no, absolutely. So I came out to Santa Monica, California by way of the East Coast, and obviously we went to school together in Mass. Had my entire life in New England, but I followed a path in California, basically building the next generation of climate tech startups in the food space. And around the time that I started that career, I sort of identified that this is a really high risk, high reward path. There's not a lot of big exits that people can point to in this space. And I wanted some stability for my family outside of that big moonshot bet that I was working on. So I got lucky. I was renting a property at the time in Santa Monica, California, and the property sold hands to a different investor group. So, for me, I'm writing check to one person. Now I'm writing a check to somebody else as my landlord. But I got wind that in that transaction, I think it was like a threeplex that we were renting, that they made like $1 million, the people that sold it. And I was, aggressively chasing and growing my startup and realized like, wow, wait, how did this just happen? Like I'm cohabiting in this situation where this investor group just made $1 million for, kind of cleaning up a property, getting some better tenants in it, and then flipping it. And it set me on this path going from sort of like unconscious incompetence, like not knowing anything about real estate, to saying, you know what? This is a really interesting strategy for wealth building that actually is very complementary to what I'm doing today. It's very different than what I do today. And so I kind of chased down an investor group. I was like, emailing him and calling him saying, guys, can we grab coffee? Can I pick your brain, whatever?
I don't think kind of. I think you definitely chased him down.
I chased him down. It's the persistence of a founder. You do what you need to do.
Yeah.
But I ended up making a relationship and actually ended up investing in one of their deals. This is how I learned about the concept of a syndication, pulling together capital to buy a building that maybe you couldn't buy yourself. It's a larger size building, but there's a lot of economies of scale, and essentially taking a tried and true approach to value add in the multifamily space. So really just creating better dynamics than what we had. Bless you. And so the first deal I did, it was a funny deal. This property, it was across the street from a graveyard in a very up and coming part of Los Angeles. This is back in 2014, mind you, so more than 10 years ago. But that year I did not have like graveyard property, 25 units on my vision board. Like this is pretty out there stuff. But I took the gamble. I scraped together everything I could. I wired the check, and I sort of sit back, and 3 months later I get my first distribution. It's like, oh wow, $2,000 landed in the bank account. Another distribution, $2,000 landed in the bank account. And I start getting this like drip of cash flow. And I realized like, well, A, good, I'm not going to get scammed. B, I guess the tenant's kind of like the green space at the graveyard, but C, like 3 years go by with this deal. And this sponsor group quietly sells it for double what they paid. We all get a great little clip on that investment. And I realized this is like this kind of interesting risk reward proposition that's totally separate from this really high risk, high reward thing that I'm doing in my day job. And I went heavy into that strategy. I invested heavily once I saw the writing on the wall and the proof points of what this could do to round out my family's portfolio essentially at that time.
Yeah, I love that. And one, I just give you a ton of credit for chasing them down, and two, sort of seeking out the strategy. And now, like, as you grow the organization, you grow the firm. What's the philosophy, or what's your sort of your MO for the organization and the way you're building the portfolio?
Yeah, absolutely. So now I do this full time, and I've been a full-time sponsor for more than 5 years, an investor in over 100 deals. And I've put together a lot of what I think makes a lot of sense. Downside protection is everything for me. And when I look at what we're investing in, whether I'm a passive investor writing a check or I'm doing something actively like I am today, it was always about how do I make sure, number one, I'm not going to lose money on this deal. So buying super well. But what buying super well means to me is looking in overlooked markets at overlooked assets, typically from sellers that haven't had a chance to bring that asset to what we know its glory could be. And so where that drives us these days is into kind of second tier and tertiary markets throughout the country, but particularly in the Sun Belt, a little bit in the Midwest, where we see opportunities that these markets are growing, tenants are coming in, they're landlord-friendly places to invest. But frankly, mom and pop owners are not keeping up with modernizing the housing, making it safe, making it affordable, making it a place that you'd have pride of rentership. So we'll generally go in, pool together investor funds to go buy, somewhere between a 75 to a 200 unit building. And generally speaking, we're in markets where mom and pop can't do that, and private equity isn't really looking there. They want to be in Phoenix and Dallas and Boston, right? And we're in Oklahoma City, or we're in West Texas, and we have these kind of big fish in a small pond type investments where we focus heavily on creating yield, and then ultimately protecting the downside, letting rents come and increase in that area, which drastically will increase the property value, and then we'll angle towards an exit, usually after like a 3 to 5 year hold period.
Got it. And where do you find like the best ROI typically on the rehab? Are there like these 5 things are just no brainers? You have to at least paint the place. You've got to, you got to put in these features. Like, are there things that you're doing almost every single time that improve the ROI, improve the renter's experience too, and make them want to stay? Like, what are you doing?
Yeah, that's a great question. And it is a little bit asset dependent, right? And it's a little bit market dependent. You find that tenants may value different things in Cleveland, Ohio, where we have a pretty significant fund. We're actually one of the largest multifamily owners in Cleveland. But then also, like, you'll be in Texas and it could be a totally different subset of things.
Maybe it's air conditioning in Dallas.
You're right. Yeah. Although Cleveland's starting to need it more and more these days too. Yeah. But generally speaking, people want some level of attractiveness, especially in workforce housing, which is our specialization, right? I'm not talking about Miami high rises with the marble countertops. Yeah. It's kind of a funny comparison, but Iván, have you ever rented, like an American-made car in a foreign country, like a developing country, like a Ford Focus in Mexico?
Sure. You've
got the dashboard, right? But there's the area where the GPS little electric part would be. It's not there in Mexico. But you've still got the same safety. You've still got the airbags. You still got the comfort. But maybe it's not the ventilated seats. right? It's kind of that standard is what we do in the housing area. And, these aren't places necessarily that an ultra high net worth investor would want to live. But for the tenant quality that we're serving, we're generally looking at people that are in the median 50% income in the market.
Okay.
And so they're used to seeing kind of crappy stuff. And then they come around, they go and they see something we have and they're like, wow, this is clean. I'm really happy to see this in my price range. And we never have an occupancy problem.
Right. I mean, you use the phrase pride of owner or pride of rentership.
Pride of
right?
rentership.
Like that is one, I've never heard that, but it makes a ton of sense, regardless of whether you're owning the home or renting the home, like where you live, people want to feel comfortable, want to feel, at home in that place. And so being able to feel pride in that, I'm assuming you're getting, like you said, you're not having a problem with occupancy because they're telling their friends, hey, this is an affordable place to live. Friends are coming by. What are you paying this for rent? And also, if you have a level of pride in the rentership, then you probably take care of the place a heck of a lot better than you would if you're like, this place was a dump when I got here. It's a dump when I'm leaving. Like I'm out. Like are you seeing a lot of that in sort of the areas that you're working in?
Absolutely. And what's interesting is I say pride of rentership. I talk a lot about we're elevating the standard of affordable housing. We're out to try to put 10,000 new housing units online in America in the next few years because it's completely unacceptable to have high demand cities with boards up in different properties, and they're all over America. And yet all of this is non-concessionary. The returns can be staggeringly good for this kind of approach by simply just doing the work and not overdoing it, just finding that right balance of delivering something that the market wants, buying right, protecting the downside, and then building something that ultimately gets leased up and increases in value so that we can compound our investors' returns.
It's a really interesting sort of balance that you're talking about here because what you've been doing is really serving a huge need, providing pride of rentership to communities that haven't had it before, but also getting a legitimate return on the investment, right? So you're right, it doesn't have to be mutually exclusive. Everybody wins in that scenario, right? So I love that idea. Are there markets where you're thinking, hey, we could probably find more opportunity, or do you feel like this is going to be something that you can continue with this philosophy for a long time, or do you think you're going to have to pivot at some point? Like, where do you see this kind of headed?
I think we've got years and years of opportunity, especially today. We've had really an interesting road in real estate the last 4 years or so. And by the way, for anybody listening, real estate is probably more decoupled from the stock market than it's been in a decade, if not several. It's very, very different. Stock market's hitting all-time highs. Real estate's in a relative low because it's so dependent on interest rates and the building that occurred in the last 3 or 4 years due to the kind of free money that came post-pandemic is now already sort of priced in and out in the world, where once rates started to go up, a lot of the buildings stopped or declined exponentially, but the tenant demand increased with the building because new family formation, immigration surprisingly is a major driver. There's all this demand for the new product that's brought online. Things in the next couple of years are changing so drastically where, even if rates come marginally down, there's just a supply and demand imbalance where for the last several years, it's been a little bit oversupply. We've already crossed the threshold where supply is on its way down and demand exceeds supply. And that's the kind of force that in high demand cities can create significant, potentially double-digit rent growth that compounds the value of assets exponentially. And by the way, I didn't even use the word inflation. So it's just the law of basic supply and demand.
I love it. And are since you've been doing this and raising your own capital and making these investments, are there any projects or any things where you're like, oh, I wish we had done this differently, or any sort of like hard learning experiences or things that you wish you could have done over?
So one of the big things we've learned, especially being in like a national owner in several markets, is you're really only as good as your localized property management. I live in Orange County, California. I have operating partners throughout the country, but some areas we essentially have learned we need to go in and actually sort of build out our own management company to deliver the standard that we would expect. And a lot of people get this wrong, especially a lot of syndicators that came into the space in the last 3 or 4 years, kind of chasing money and saying, hey, I can do this. They never realized that at the end of the day, whoever's running your on-site property management and whoever's running your localized, sort of higher level management company is going to make or break the investment. And if they're not good, you're toast.
Yeah,
right?
yeah, yeah.
So that was a learning early on.
You don't have the ability to be there, boots on the ground at all times, and
Yeah,
working through
exactly.
these things. And so, are you? So what you? If I heard that correctly, in some areas where you find the opportunity, but you don't necessarily have a working force yet, you're having to go in there and basically set up like a whole brand new company entity,
Yeah.
And sort of outfit to make sure it gets done correctly.
That's correct. We'll either do that ourselves or we'll work with a local property management company if they're receptive to receiving that and they're willing to work with us. And we'll basically bring and elevate their standards. And what's really interesting is we have a trail of outperformance of what this does to those management companies. At some point, you'd think I'd just start a property management company, but I'm pretty in my lane here.
There you go.
But it's about creating the standard that we'd expect, right? And in general, like when you're looking at these deals, when you're looking at the opportunities that are out there, and especially I'm talking about distressed opportunities, you tend to see really only two lanes of distress. One is on the operations side, which is this, how good is your operations and property management? The other is on your sort of your financial engineering side. And a lot of people right now that got loans 3 or 4 years ago that are adjustable today, that's a period of distress where there's actually nothing wrong with the management of those properties. It's that your rate just went from 3% to 6.5%, and you weren't capitalized to ever do that. And so we're seeing some of the syndicators in the world either giving up their keys or selling for discounts. Right now, it's a great time to be a buyer, and there's nothing wrong with those assets other than they weren't structured well 3 years ago.
Got it. I love that. And are you? How are as AI changes the dynamic in many different industries? Like, are there different ways that you're leveraging technology, or either personally, professionally, like within the organization? What are you doing with AI these days?
Yeah, I mean, we do a lot. We've built out some solutions for quickly analyzing new properties. We're actually in the process of building an AI agent suite that responds directly to prospective tenants, to get them into properties more quickly. And we recently went through a situation where we bought a property in January, an 86-unit deal in West Texas at 60% occupancy. This is one of those operationally challenged properties when we bought it. But we forced an appreciation of the entire property by renovating it, figuring out what the tenants wanted, and ultimately needed to lease it up. And we found AI and VAs, by the way, to be really helpful in that sort of final step of lease up, getting that property out there, getting people in the door, getting their applications processed, and bringing that asset to 95%, which creates more than $1 million in investor value. So
That's
it's key.
Yeah, that's huge. I love that. And any thought to like licensing some of the technology that you're putting out there and using for the organization? Are you selling it yet? Are you thinking about selling it? What do you think?
It's a great conversation. I haven't, to be honest. I've been so focused on just managing these properties well. It's really good food for thought.
Yeah, I love it, man. What's the next project? Where are you spending some time these days? Like, where do you find the next opportunity?
So we have, I'd say, 4 main markets in the Southwest we're looking at. I like what's happening in Arizona a lot. And again, you have this interesting kind of moment of distress in Phoenix and Tucson. We're looking in Oklahoma City, and then we have a couple key markets in West Texas where we're pretty active buyers. In general, we're targeting 1 deal per quarter. So not a crazy amount of deal flow, but it's quality over quantity. And it's getting in the right type of opportunities. And we're raising anywhere from $3 to $10 million in equity checks for these deals. We actually just got back from one last week We had it under contract. I mean, this thing looked like a unicorn, Iván. 3.5% assumable rate debt for multiple years, in a market that's about to get a $300 billion AI data center. Everything on this checked the box, and we're ultimately walking away from it because, simply put, what we saw on the ground, the numbers weren't what were on the brochure, and the property management and the people we interviewed were not going to essentially vouch for what we originally saw. And then further, in looking at that market, we went to a bunch of different competitive properties, and we saw they're nicer and they charge the same. And that means we have to be nicer if we want to charge any more.
Yeah.
It's not going to make sense. So even in those situations, we'll walk away from what would otherwise be kind of a unicorn deal.
Yeah. I mean, listen, I think you've also got to trust your gut right at this point. And
Yeah.
so if you're seeing things, it's refreshing to see you walk away from an opportunity like that, even though, you probably wish you had written the check, but ultimately you'll get to spend your time and energy on something that hopefully will get a better return for you.
You got it. Exactly.
I love it. As we're kind of wrapping up, like, are there any things that you want to sort of have the listening audience kind of take away about, the industry, about different ways to sort of view what these syndicates look like? Like, just curious, kind of, your final takeaway point.
Yeah, I mean, we've been doing a lot of studying on how high net worth investors invest versus the ultra wealthy, let's say the 1% of the 1%. And I'm really curious too, Iván, what you see and advise at Opus. One of the things that really stood out to me when we were digging into the data, we saw that on average, at least in my data set, there's something like 22% of a high net worth investor's portfolio is in alternatives, which should be like real estate, private equity, commodities, things like that. In the ultra high net worth domain, it was like north of 45% in the data that I saw, more than double. And I think it's such an opportunity today. We've had sort of this groundswell of access for private investors to get into alternatives at a rate we've never really seen before. It's almost the democratization of the asset class. And I'm really excited about what that can do as people are really being more thoughtful with portfolio allocation and not just defaulting to the 60-40, stock and bond approach. And then further with real estate, you don't just have one way you get paid. You're really talking about 4 different levers between the cash flow that can come off of a property, the debt pay down that, by the way, your tenants are doing for you, the tax efficiency and the levers that can go there, and then ultimately the appreciation that both comes from the market you're in and what's happening nationally, but also that you can force by making better operations or making a better capital stack. So I get really excited when I think about the opportunities that creates for high net worth investors that are looking for an edge.
Yeah, I think you're spot on. Like as our conversations kind of evolve over time with clients, we are oftentimes looking at private equity, private credit, trying to include, more diversification inside of the portfolio. Now we're having conversations over the last few years around cryptocurrency and real estate, and just how do you look at a complete holistic portfolio, not just stocks and bonds, stocks, bonds, and cash. It really has evolved over the years, and we've always been a proponent of diversification, not just from an asset class standpoint, but also like liquidity. Which assets are liquid at what points in time, which ones are leverageable. How am I going to get my capital back? How is my money going to continue to compound even though I'm using those dollars for something different? What's the tax implication of it? So diversification is like multifaceted, and we're really trying to incorporate as many levels of diversification into somebody's overall portfolio so that they are in a position of strength when it comes to investing at all periods of time. Because there's so many external factors, but I can't control, what the government does, what the tax law changes come across, what market risks look like, market trends, like all those different things we can't really control. We're just trying to have as many options, right? And I think, as we look to continue to do that and we try to impart those things in our clients' portfolios more and more and more, we're starting to see the wealth creation actually take place the longer these things start to compound. So it's very much a part of our philosophy, which is part of the reason why I wanted to bring you on, just to have you sort of talk more about the space in general and see and educate the folks on what you're up to.
I think that's spot on. And when you say that about diversification, I mean, I've always just felt like by being diversified, it's really sleeping better at night.
Yeah.
I don't have to worry about the headlines so much. And especially when you kind of know what you're in, there's a supply and demand story, or there's something just more simple and fundamental towards it. And you have a number of those different things and you just know where you sit. I mean, that's true freedom. It's peace of mind.
Most definitely. Well, listen, man, I really appreciate the conversation. I know that this was super valuable for the listening audience. It was great for me to hear more about what you're up to again, and wish you all the best of luck and success with the fun. Appreciate you, and have a great rest of the week.
Hey, thank you. You too. Take care, Iván.
And to you, the listening audience, thanks for tuning in. Please click subscribe below to be notified when we have our next episode. Talk soon.